Subscribe to our channel and click on the bell button to receive important financial updates faster than anybody else. Friends, welcome to another video on your channel Profit and Equities. Now, if you like our content, please don't forget to hit the like button. Also, subscribe to our channel and click on the bell button to receive important financial updates at the earliest. Now, today we present to you 5 stocks which Angel Broking has highlighted as safe in the current market scenario. Now, since the budget and the imposition of long-term capital gains, there has been bloodbath in the markets. There have been a lot of small caps and mid caps which have literally got butchered. Now, in such a market scenario, it is imperative that we have some safe stocks with us which we could accumulate when the valuation is favorable. Now, these ideas are not part of a research report per se, and these have been shared on a financial website and with inputs from Amarjit Maurya of Angel Broking Private Limited. We'll be providing a link to that article in the description section below. Please go ahead and read the complete article in the URL provided and then take a decision of whether these stocks meet your investment criterion. Also friends, if you are benefited by the content on this channel, please don't forget to share this video because it could help our channel grow and you would stand to benefit others as well. Please watch this video to know more. Now, the first stock on the list is Dewan Housing Finance Corporation Limited, which is available at 576.30. The target price by Angel Broking has been kept at 712. The symbol for this stock is DHFL, and this is a deposit-taking housing finance company. The company focuses on providing financing products to the lower and middle income segments in India, primarily in Tier 2 and Tier 3 cities. Now, the one-year chart reveals that this has been on a consistent uptrend, other than the period recently where there has been a fall on account of the general market correction. Now, the market cap is 18,076.16 crores, which means that the company is a mid-cap one. The EPS is 98.11, which makes the stock available at very cheap price to earnings ratios of 5.87. The industry PE is 28.22, which again indicates that this stock is trading at much cheaper valuations compared to the industry. The book value is 254.94, which again means that this company is available at decent price to book ratio of 2.26. The dividend yield percent is 0.69, whereas the promoter holding is below average at 39.23. Now, if you were to look at the reasons which have been provided by Amarjit Maurya, backed by healthy capital adequacy and increasing demand for home loans, DHFL's loan book is expected to report 23% loan growth over the next 2 to 3 years. Now, DHFL has sold 50% stake held by it in DHFL Pramerica Life Insurance Co. Limited, which added rupees 1969 crores to his net worth and increased its CAR by 400 BPS to 19.3%, which should further fuel growth over the next 2 to 3 years. Strong net interest margin on the back of lower cost of funds and lower credit cost will ensure healthy return ratios for the company. Despite strong growth, the company has maintained stable asset quality, and Angel Broking expects that this trend is likely to continue. Now, they expect the company's loan growth to remain 23% over the next 2 years, and earnings growth is likely to be more than 28%. They maintain buy on the stock with a target price of Rs 712. Now, the second stock on the list is Siyaram Silk Mills Limited, and this is a company which is a holding company and is engaged in manufacturing fabrics and ready-made garments. Now, the price currently is 655.25 and the target price has been set here as 830. The symbol for it is SIYSIL. The one-year chart reveals that this company was also on an uptrend before the recent fall, which is on account of the market correction. Now, the market cap of the company is 3071.16 crores, which means that the company is a mid-cap one. The EPS is 22.88, translating into a price to earnings ratio of 28.64, which is also slightly cheaper compared to the industry PE of 31.34. The book value is 127.29, which means that the company is available at expensive price to book ratio of 5.15. Now, the dividend yield is 0.46, whereas the promoter holding here is good at 67.07. The 52-week high for the company is 2799.90, whereas the 52-week low is 327.99. Now, if you were to look at the reasons provided by Angel Broking, Siyaram Silk Mills has strong brands which cater to premium as well as popular mass segments of the market. Further, SSML has entered the ladies salwar kameez and ethnic wear segment. Going forward, they believe that the company would be able to leverage their brand equity and continue to post strong performance. The company has a nationwide network of about 1600 dealers and business partners, and it also has a retail network of 160 stores and plans to add another 300 to 350 stores going forward. Further, the company's brands are sold across 3 lakh multi-brand outlets in the country. On the back of market leadership in blended fabrics, strong brand building, wide distribution channels, strong presence in Tier 2 and Tier 3 cities, and emphasis on latest designs and affordable pricing points, they believe that at the current market price, SSML trades at an inexpensive valuation. They recommend a strong buy on the stock, and they have a target price of Rs 813 to look forward to. Now, the third company on the list, and probably one of the greatest wealth creators that there is in the Indian stock markets, Maruti Suzuki India Limited. This stock is currently available at 8698.80, and the symbol for it is MARUTI. Now, the important point is the target has not been mentioned as such here, and hence we have not been able to provide it here. The company is a holding company engaged in the manufacture, purchase and sale of motor vehicles, components and spare parts. The other activities of the company comprises facilitation of pre-owned car sales, fleet management and car financing. Now, if you were to look at the 1-year chart, it has been on a consistent uptrend other than the recent period where the general market fall has led to a decline in price. The market cap of the company is 2,62,773.40 crores, which means that this company is a large cap one. The EPS is 249.89, translating into a price to earnings ratio of 34.81, which is also slightly expensive compared to the industry PE of 31.07. The book value is 1197.40, which translates into a price to book ratio of 7.26, which again is expensive. The dividend yield percent is 0.86, whereas the promoter holding is average at 56.21. Now, if you were to look at the reasons provided by Angel Broking, the automobile sector is expected to benefit from the GST implementation, and the sector has seen a pickup in the volumes in FY17 as there were several positive factors like a normal monsoon and lowered interest rates. Now, Maruti Suzuki continues to hold 52% market share in the passenger vehicle segment, and the launch of exciting models has helped the company to ride on the premiumization wave that is happening in the country. In the last 2 years, the company has seen improvement in the business mix, with the pie of the utility vehicles growing from close to 4% to current 15%. Due to the favorable business mix, the company has also been seeing improvement in its margins. Now, together with higher operating leverage at Gujarat plant, increasing Nexa outlets and improving business mix, they believe that the company has further room to improve their margins. They have a buy rating on the stock. Now, the fourth company on the list is TV Today Network, and this enjoys a strong viewership ranking in the Hindi and English news channel categories. Now, if you were to look at the company, TV Today Network is engaged in television programming and broadcasting activities. The company operates in various markets such as television, digital media and radio. The company operates various news channels such as Aaj Tak, India Today Television, Delhi Aaj Tak and Tez. TV Today Network Limited and Mail Today Newspapers Private Limited are the subsidiaries of the company. Now, this stock is available at 455.15 and the target price here has been set at 560. Now, if you were to look at the 1-year chart, you would see till the middle of the year the stock was doing nothing and consolidating, and since then has been on a consistent uptrend. The market cap of the company is 2715.13 crores, which means that the company is a mid-cap one. The EPS is 20.34, translating into a price to earnings ratio of 22.38, which is much below the industry PE of 46.43. The book value is 104.88, translating into a price to book ratio of 4.34, which is slightly expensive. The dividend yield is 0.44, whereas the promoter holding here is average at 57.42. Now, if you were to look at the reasons why this stock has been suggested as an outperformer, TV Today Network enjoys a strong viewership ranking in the Hindi and English news channel categories. The company's Hindi news channels, Aaj Tak, has maintained its market leadership position, occupying the #1 rank for several consecutive years in terms of viewership. Its English news channel, India Today, has been continuously gaining viewership and has now captured the #2 ranking from the #4 spot earlier. Its other channels like Delhi Aaj Tak and Tez are also popular among viewers. Now, TTNL is a play of higher operating leverage that would be visible as advertisement revenues gain traction. Going ahead, they expect EBITDA margins would also improve. Now, they recommend a buy with a target price of rupees 560. Now the final stock on the list is KEI Industries Limited, which is engaged in the manufacture and supply of power and other industrial cables. The 1-year chart shows that this company has been on a consistent uptrend. The market cap of the company is 2926.02 crores, which means that the company is a mid-cap one. The EPS is 16.16, translating into a price to earnings ratio of 23.11, which is much cheaper compared to the industry PE of 28.56. The book value is 60.43, translating into an expensive price to book ratio of 6.18. The debt to equity here is 1.1912, whereas the return on equity is 0.1865. The dividend yield by the company is 0.16%, which is on the lower side, whereas the promoter holding here is below average at 46.26. Now, if you were to look at the reasons why Angel Broking has chosen this stock, KEI's current order book stands at rupees 2780 crores. The segmental breakup is rupees 1990 crores in EPC, 560 crores in cable, and 230 crores in EHV. Its order book grew by 28% in the last 3 years due to strong order inflows from state electricity boards, power grid, etc. KEI's consistent efforts to increase their retail business from 30 to 32% of revenue in FY17 to 40 to 45% of revenue in the next 2 to 3 years on the back of strengthening distribution network and higher ad spend is expected to go ahead and benefit the company a lot. KEI's export is expected to reach a level of 14 to 15% in the next 2 years with higher order execution from current order book and participation in various international tenders. Angel Broking expects a strong 26% growth in CAGR over FY 2017 to 19 in exports, and KEI is likely to report net revenue CAGR of 13% to rupees 3392 crores and net profit CAGR of 19% to rupees 140 crores over FY 2017 to 19. Hence, they have an accumulate rating on the stock. Also here, the target has not been provided. Now friends, please don't consider any of these to be stock recommendations. Please go ahead and do your own research. And this is all what we wanted to show you today. Thanks for watching, and we will be seeing you soon with another video.